Okay, so yeah, let's start the second hours. Okay, so yes, in the end of the first hour, we have already shown you how to draw how to plot the efficient frontier, and if we have the data point, yes, we can must to find the efficient portfolio. Okay, efficient portfolio. Okay. And actually, all of the coding and the data using the class, I have already uploaded to the e-learning. So if you want to know the details, you can just download the coding and the data and then you can run it. And you can, again, if you have any question or when you run this kind of program and struggle in the debug some problem, yeah. Feel free to tell me, okay? We can discuss it. Yeah. Okay, so about the first coding, about the first cell of the coding. Here, actually, yes, I moved too fast. Okay. Actually, here I just want to try to draw this figure to you. Okay, again, the exponent here is the standard deviation, and the expected return is our y-axis. Okay, and here I'll try to assign a different rho value, the correction value between our risky asset, and as you can see, if the rho, the correction coefficient between the portfolio, the asset within a portfolio, we can have the zero risk because the standard deviation here is 0, but the return is maybe around 9.8%. Okay, so this figure I just want to show you how to if we can find the asset and they are exactly perfect negative to each other. Okay, so I do theoretically we can have the 0 risk and the high return. Okay, 0 risk and high return. Okay, but it is the ideally case. In reality, we don't have that. We don't have that. Okay, any question? Any question? No. Let's move to yeah. Okay, so far from the efficient frontier, we can answer the above question, right? Which risky portfolio we need to choose? Okay, we can choose which risky portfolio to put the money in the portfolio. Okay, so the short answer is investors should only invest the money on the portfolio. Okay, and this portfolio, this kind of portfolio is located in the efficient frontier. Okay, so actually this week, I just want to answer these 2 questions for the student. Okay, for the student. So the efficient frontier can help us to answer the second one, the risky portfolio decision. Okay. So now let's try to combine, or let's try to answer the first question, the capital allocation decision. Okay. And the allocation decision is to decide that we put our money between, or look at the invested money between the risk asset and the risk-free asset. Okay. So. So now, suppose a risk-free rate asset is $1 now. So in the slide before this page, we do not consider the risk-free rate, right? We only consider the expected return, risk, portfolio. That's it. And the strike ratio, of course. So now let's introduce the risk-free rate into our analysis. Okay? So after if an investor can also put their money in risk-free assets, or you can think about that, just they can put the money in bank, and then they can also put the money in the stock market. Okay, so in this case, how does this change the efficient frontier? Efficient frontier. Okay. Any question? No. No, thank you. Okay, so here is a capital allocation decision. Okay, and how should wealth, which is that how should wealth be allocated between risk asset and the risk-free asset? Okay, so again, we have the formula or equation of the expected return of complete portfolio. So this C denotes the completed. So why we call completed? Because now we consider both risk-free rate and the risky portfolio. So why we call it the completed? Because in reality, we should make decision like this one, right? You put the proportion of your money on the bank, and another proportion is used to invest in the stock market or other asset portfolio. Okay, so that's why we call it completed portfolio. Okay, so according to the equation, here we know that the expected return of the completed portfolio is equal to the fraction invested in the risk portfolio, the fraction here. And then another one is 1 minus y. Y is fraction, yeah, 1 here. And times the risk-free. Okay? Yes. Any question? So for example, if now you have the $100, and you try to put the maybe $60 in the bank. So this one maybe is the 60, and the other one is 40. Okay, very easy, right? Accountably easy. Okay. Okay, so then we can rearrange this formula. Okay, become this one. Any question? We just put plug in the IV inside and then rearrange the formula, and then we can get this one. Yeah, you should be okay with it. Yeah, okay. So, yes. So the portfolio return equals to the risk-free rate, this one, plus risk premium, proportion to the fraction invested in the risk portfolio. Okay. Intuition. So now again we focus on the completed portfolio, and the start point is that we try to calculate the expected return of the completed portfolio. Okay, and then we just use the we just rearrange the equation here, and in the end we will have this one. It should be easy to move the term to right hand side to left hand side. So a single task you can finish by yourself. Okay? So here the conclusion is that the expected return of the completed portfolio is equal to risk-free rate plus risk premium. And then we consider the proportion that is fast. Okay? Any question? Any question? Okay. Okay. So now, suppose an investor put wealth between the risk portfolio P, the fraction P, and the risk-free asset F. Okay. So the overall risk of this completed portfolio is this one. Because we said that the risk-free rate, the risk is 0. Okay, see? So that's why we see this equation here. Okay, so because risk-free asset has zero risk, therefore the portfolio risk depends on only proportion invested in the risk portfolio. Like this one here. Okay, next step, like this one. Yeah. So now we have the expected return of the portfolio, I mean the converted portfolio, and the risk of the converted portfolio. Okay, so therefore we can have the CL, capital allocation line. Capital allocation line. Okay, so now we try to combine the expected return and the risk of the completed portfolio. Okay, so now the expected like this one, right? The expected return of the portfolio is equal to risk-free rate plus the proportion of the time, the proportion invested in risk asset times the risk premium. So why I call this premium? Because it's the portfolio return minus risk-free rate. So this part we also call the risk premium. Risk premium. Okay? And the risk here, we already mentioned it before. Okay? Yes? So, yes, we just combine this one. And then because y, we can just move this sigma p from right hand side to left hand side. And then y is equal to sigma c divided by sigma p. And here we have y. So, the expected return will become IF risk-free rate plus the risk premium times this part, And this part comes from this equation. Any question? Any question? Yes? Okay. So can we? Okay, so let's look close in this equation. So the intercept here, this one is the risk-free rate. Okay, and then the slope here is the Sharpe ratio, right? Portfolio risk and the risk premium. This term actually is Sharpe ratio. Okay, so therefore we have the capital allocation line. We call this equation as the CL. Okay? Any question? Any question? No? Okay. So economic meaning. So the CL shows all possible combination of the expected return and risk. Okay? And the capital allocation line represents the trade-off between the expected return and the risk. Okay, so more important is that the CL can tell us how much risk to take. Okay? But it does not tell us which risky asset to hold. So that's why we need to combine the first part of the diversification part. We need to select the efficient portfolio. Okay, and from the CL, the story of the CL tells how much or how fraction of the asset you should put in the risk-free asset, and what fraction you need to put it into the risk asset portfolio. Okay? Yes. So yeah, we already answered it. Yeah, because I have moved the order in the slide, so that's why here we have the question. So I'm really appreciative for this one. Okay? Because really I want to introduce the CLO first, but I feel that if we don't introduce the diversification and the portfolio concept, and then we introduce the CL directly, it will be weird. So that's why, anyway, I'm happy here. yes, so when a risk-free asset is available, the capital allocation line can be drawn from the risk-free rate. Okay. So yes, maybe we can just look at the figure directly more clear. Yes, so this straight line, actually we can have, according to the figure here, we can note that actually we can have a lot of CL, right? Because different investors have a different risk tolerance. Okay, so if we are more, if I'm the risk averse, then the slope of the CL will become steep, right? And if I'm more like the risk, then the CL will more flat. Okay, so actually in the real world, we have a lot of, we just said that each investor have their own CL because the risk tolerance, the degree of risk tolerance for each investor are different. Okay. So here we can see we have the CLP, CLA, CLG. Okay. However, only one situation is the best situation. Only one situation. Yeah. The best CL is one that the tangent to efficient from T. The tangent to efficient from T. Why? Because this point provides the highest Sharpe ratio and the highest return per unit, which means the highest return per unit of the risk. Okay, so the tangent point is called the optimal risky portfolio. Optimal risky portfolio. And investors will combine this portfolio with the risk-free asset according to their risk preference. Okay? So the tangent point is P, right? So the P here we call the optimal risk portfolio. Okay? Yeah, this one. Any question? Any question? No? Really? Yeah, when I prepare, however, when I prepare this slide, I just think about that. Now we have the efficient frontier like this one, right? This one. I just think about the stupid question. And maybe the tangent, like this one. The tangent point like this one, right? Like this one. But why we don't have the figure like this one? Why? Why don't have the figure like this one? Why we focus on tangent point? Why? Do you want to want me? Yeah, because we can understand that this point is F, right? So if we not in this kind, if the CL and the frontier is integral to each other, then we can have a several situation. And then under this situation, the best point is the tangent point, this one, because here, if we consider the A point and B point, the A point has a higher Sharpe ratio. So we said that the tangent point is better, is best decision. But my question now is that why we only focus on, or why we assume that these two lines must be intersect each other? Why we do not consider this case? Why? Do you know what I mean? Do you understand my question? Why? If these two lines intersect each other, yes, I can. It's easy to understand the change point is fast because we have the highest Sharpe ratio, yeah? How about this one? Why? Does anyone can help me to answer the question? To know my question?
Because including in the future frontal we have all the assets portfolio, but out of the frontal we don't have any portfolio.
Yes. Yes, correct. Yeah, because I prepared the material here, and I just think about why? Yes, why? Why we so only focus on this one, and we do not consider this one because it's impossible. It's impossible to find the situation like this one. Okay? Any question? Okay? And the reason just like her explanation. Yeah? Maybe a stupid question, but I just want to go to when we learn something, learn a new concept or refresh the concept. We need to keep the attitude to X, Y. Yeah. Okay. Any question so far? Any question? Okay. Okay, so if you agree the story here, then the stoppage is that we have the several CL line and the efficient frontier, and the best decision is the CL line tangent the efficient frontier. Okay, so if you agree this story, so now we can answer the two basic or important question in the beginning of the course. Okay, so recall that in fast two basic portfolio decision. One is capital. The first one is capital allocation decision, and the second one is risk portfolio decision. We already answered this one, right? Efficient portfolio. So now let's try to answer this one, the capital allocation decision. Okay. And the answer is that the risky portfolio decision, if we assume that all investors are rational guys, okay, if all the investors are rational investors, all investors will choose the optimal risk portfolio, optimal risky portfolio, okay, because this point provides the highest Sharpe ratio. And the second question is that the capital allocation decision. Yes, the investor have a different risk tolerance. Okay, so we have a lot of simple CL. Okay, because the CL represent a different risk tolerance of each investor. Okay, so the conclusion in this slide is that the portfolio choice can be separated into two dependent tasks. We call the separation property. Because now let's back to the figure. We know that this P is the best case, is best situation. So now, if you are the risk averse guy, you will put more money, maybe more close to this one, the point F here. Okay, and then if you more like risk, more risk, high return, you are a risky guy. You can put more proportion of your money on P, okay, on the point P. Okay, so that's why we call the separation property, because yes, that's actually this one. Because when you decided that which portfolio you need to invest, and you need to put what fraction of your overall money on the risk-free asset and the risk portfolio. Actually, it's two different questions. two different questions. Okay, so that's why we called the portfolio choice can be separated into two dependent tasks. Okay. Actually, the similar properties also exist in the financial theory. Do you think about that? Yeah, hold on. Any question for this one? Separation property. Any question? Okay. Okay. And another story, the similar stories exist in the financial company management. So let me ask you, the student, the most important question in the financial management, which is the most important mission of the firm manager is what? What is the most important task for the firm manager? What is the task here? Is to maximize the what? Maximize the stock price?
Profit.
Or
Profit.
profit? Equity? What? Utility. Stockholder utility. Okay? But another question is that when after the company got listed, they can have maybe 10,000 or 1,000 of the stockholder, and each stockholder have a different utility. Right? So how the firm manager do the best situation when they need to make the financial decision? They need to fit or to convince all the stockholders, right? So actually, actually there is a similar idea. Yes, we also call the separation. I remember in the financial management we call it separation theory. Yeah. I just told you that the similar process, but here I just want to tell you the conclusion of the separation property in the financial management. Yes, the final conclusion is that the stockholder will choose the type or the style of the firm manager they like. So when the firm manager make the final decision, they only focus on maximize utility. It's okay, because the investor will choose which kind of company they like. Okay, so this is another separate theory. So the firm manager just focus on how to minimize the utility and how to attract the investor is another story. Okay, here is another separate decision making. Okay? Any question? So this is what we call the separation property. Yes? Any question? No. Okay. Okay, so finally we have the CAPM model. Okay, we have the CAPM model. So what is CAPM? What is the CAPM? So CAPM is the foundation theory in the finance used to determine the theoretical appropriate required rate of return of an asset. Okay? And because CAPM is the model, okay, the equilibrium model. Okay? So yes, it focuses on the equilibrium expected return on the risk asset. So we have the safe flow assumption. We have a safe flow assumption. Okay? So the first, maybe we can separate into two categories. The first one is the individual behavior. So you can think about the investor behavior here. Okay? So investor choose a portfolio based on the expected return and the risk. Okay? So it's we will also call the rational assumption, rational investor assumption. So which means that all investors plan over the same time horizon. Yeah, maybe for example, all investors just focus on the investment period only 1 year, and all investors of their plan is only focused on 1 year plan. Okay, and the next one is the all investors use the same information and expectations. And then this one we call the homogeneous expectation. Homogeneous expectation here. Okay. And the second category is that the market structure. All assets are traded in the public market, and investors can borrow over them at the same risk-free rate. And the market have no tax and over the transaction cost. Okay. And so far, any question? Any question? Okay. No. Okay, so the implication of this assumption. Actually, this assumption is very important. Even now, we still try to release the assumption of the campaign and try to publish a paper. For example, we know the behavior finance, right? Actually, the basic assumption of the behavior finance is conflict to this one, right? And this one, the homogeneous expectation. Okay, and also the rational investor, because why the behavior finance can exist? Because we understand that not all the investors are rational. Okay, there must someone traded their stock based on wager. Today is raining. Okay, I sell the stock. Okay, yeah. So therefore, that's why we have the behavioral finance, and we will dig in that time maybe before meeting. Yeah. Okay. Yes. So can I assume the investor has the same information and the same market condition? So investor will identify the same optimal risk portfolio because they have the same information. Okay. The only difference between the investor is their risk tolerance. So again, the capital allocation question, they will need to answer the capital allocation question. Okay? So the investors differ only in their allocation between the risk-free asset and the optimal risk portfolio. Okay? So in the equilibrium, the optimal risk portfolio becomes the market portfolio because all the investors have the same information and the market condition. So all the investors will make same decision. So the decision is to select the efficient portfolio. Efficient portfolio. Here we call it the optimal risk portfolio. And when all the investors do the same decision, then this portfolio becomes the market portfolio because all investors do the same decision. Okay? So that's why I'm not sure whether when you done the CL to CML before, have you think about that? Why CL just now changed to CML? Okay. Okay, so yes. So now let's focus on the figure directly more easy. So now our original point here is CL, right? But now we under the capital assumption, this point will become market portfolio. So this line, straight line, is we call the capital market line, CML. Okay? Okay, so if all investors choose the same risk portfolio, the aggregation of this portfolio must be at this point market portfolio. And in the market as a whole, borrowing and lending offset each other. This story or this concept is also very important in the asset pricing. Because why? Do we have the time? Yes. Because if your schedule of your master thesis is to do the asset pricing paper, and then actually you have only maybe 2 or 3 choices. I mean the topic direction, the direction of your topic. One is risk story, high risk high return. Another is behavior finance, and now we have a third one is AI part. Yeah, it's okay. Yeah. So you can think about that. The most important idea of the why the stock price goes up or goes down is that a lot of investors buy the same stock at same time. Yeah, just supply and demand, right? If there are a lot of investors demand this stock, then price goes up. It's basic ideal, right? But the reason behind this supply and demand is only 2 reasons. Even now, high risk, high return, we already know that. Another one is risk. But no, behavior error. Behavior error. But why the behavior finance is very difficult to publish or difficult to convince the reader? Because this reason. If some irrational guy overreact the stock price, there must be another one is underreact the information, right? So overall, overreact part and underreact part will eliminate each other, offset each other. So that's why the high risk high return in the investment area is more popular, because it's more easy to convince the reader. Okay. Do you understand what I'm saying? Yes. So here, in the market as a whole, yeah, because when we do the research, we focus all the market, whole market. So in my refrigerator, then I can always see that, okay, your story is not quite interesting, but why you said some investor is overreaction to the information, but why is not eliminated by other one, and who is maybe underreaction to information? Okay, why? So just the concept of this one. Okay, if we consider the market as a whole, okay, the borrower and the lending will offset each other. Okay, any question? No? Okay. Yes. Here the portfolio will become the market portfolio, and the CNL based on the market portfolio is called the portfolio line, like this one. Okay. Yes. Let me told you. Okay. The CAPM equation. Okay. So under the CAP assumption, we can modify the expected return of now is we focus on the asset I. Okay, asset I. Okay. Which is expected return of the asset I is equal to risk-free rate times beta, and market return minus the RF. Okay, so the component here we call it the market risk premium. Market risk premium, because the expected return here is coming from market portfolio. So now we call it the market risk premium. Okay? Any question? Okay, so let's focus on beta. Okay. Okay, so this component beta here tells us how much the stock should move when the market moves. Okay. You all of the students here learned the regression before, right? Regression. Okay. So actually, this is kind of regression equation. Okay. So the beta is the coefficient of the market premium term. Okay. So that's why we said that this beta can tell us actually it just tells us correlation between the market premium and your individual stock return. Okay, so beta measures and assess systematic risk, because here we consider market premium. Or how about the market return in Taiwan? Maybe we can use the what? In Taiwan, the market return can proxy by which one? In Taiwan. Okay. Yes. Yes, correct. And later I will show you how to download the data about the market return. And for the US, we can use the value weighted return of all the listed stock. Okay, and still also we have some paper use the SPY. What is SPY? Do you know what is SPY? What? Yeah, S&P 500. And in Taiwan, can also use the which one? Which ETF in Taiwan? Okay, 0050, 0050. Yeah. Okay. Okay, so beta tells us how much the stock tends to move when the market moves. Yes, the beta measures the first step, the assess systematic risk, and we already know that because we can eliminate all the individual risk by the diversification portfolio. Okay, so the higher beta means greater sensitivity to the market movement. Okay, so in CAPM, the expected return is only depend on beta. Okay. So now the beta, we have the several, again, the situation. If the beta equal to 1, we said that the stock, when the market moves, the stock return moves about the same as the market return. Okay? And if the beta greater than 1, the stock return, when the market moves, the stock return moves more than market return. Okay? And if the beta is greater than 0, smaller than 1, yes, the return will move less than the market return when the market moves. Okay? And if now the beta equal to 0, the stock return does not really move with the market return. Okay? So now in terms of if you have the negative beta, well, you may happy because now we have a lot of work happened in the world, right? So if you have negative beta, it's better because when the market moves, the stock return moves in the opposite direction of the market return. Okay? Any questions so far? Any question? No. Okay, so according to the relationship between the beta and the expected return here, we can draw another line. Today we have a lot of line. We learned the CL, CML, from efficient frontier, and also the last one, the final one. Okay, final one, the security market line. Okay, so SML here shows the relationship between the expected return here and the beta here. Okay, so in CAPM, asset with higher beta should offer higher expected return. Okay, that is one. Okay, and the intercept here is risk-free rate, and the slope is the market risk premium. So in the final hour, I will describe how to run or how to calculate the beta from CAPM. Okay, yeah, and I prefer to use the Python to show you. Okay, yes. and we can talk about later. Yeah. So actually, we just run this straight line equation directly. Then we can get the data for each row. Okay? Okay, the final idea of this week. Yeah, okay, I hope you're still with me and I can understand my story in this week. Okay, the final story. Okay, so the application of the SML. So the SML actually can use to identify whether stock price now is fair or underpriced or overpriced. Okay. If we said that if the stock on the SML, so we call it fair price. And if a stock is above the SML, so which means that it's over more than the expected return, so this stock is underpriced. And if a stock is below the SML, it gives less return than the expected for this risk level, so we call it the overpriced. Any question? Really? Okay. So here is the example. For example, here is the example. The stock with the data is 1.2 like this one. Okay. And we have SML here. So according to the SML, if the stock with 1.2, the expected return should be 15.6. However, currently the stock provides 17 expected return. So 70% of the expected return. So since the 70 greater than 15.6, the stock offers more than the required rate of return. Therefore, the stock is underpriced and has positive alpha. Like this one. Okay. Any question? Any question? Maybe we can, if it's hard to understand, maybe I can provide another thinking for you. Based on just very simple model here, we know that the price, we can calculate the price become 1 plus the required rate of return, and the denominator is the cash flow. Okay, so if we said that from SML, the R here should be equal to 15.6%, but now is 17%. Okay, so compare these two required rate of return. The 17, if the required rate of return is 17, the price will lower, right? Because the R here is in the denominator. So higher required rate of return means lower current price, and the ideal return, the required rate of return is this one. So the current price is under, because currently the price, we have the lower current price compared to the ideally required rate of return comes from SML line. Okay? And yes, actually this concept is very, very important in the finance area. For example, if we want to proxy the benchmark return. So the benchmark means ideally the price should be maybe just like this one, 20. We need the story or we need the model to construct the benchmark return. We usually use CAPM as the tool. And in the event study or in the other research, this kind of concept is frequently used. Okay, So in the final hour, I will show you how to calculate the CAPM for each firm. Okay, take a break.